I need a lot of down payment in Vancouver. Gary is showing us average homes of 1.2 million plus, 20% down in that situation, 240. If you're just starting off, pretty hard to get into the market, right? I need a lot of income. Big mortgage, big income. So, but I'll show you it's actually easier than you think, okay? Lowest rate is the best. While rate is important, there's another factor there to keep in mind. So not all mortgages are created equal. I can't, as you build your portfolio, you might be thinking, I can't get any more mortgages or I can't get any more properties. I'll explain how you can overcome those hurdles. And insured mortgage, is it a good option or bad option? So I'll go through that example as well, and when you may want to use that to actually grow your portfolio. Okay, so I need a lot of money to start investing in real estate. Not really. Most people, when they think about real estate, they think I have to invest in my backyard. True, Vancouver is a great market, but you're also seeing that push going eastward as well, because Vancouver pricing is so high right now. It's creating, over the next 25 years, so by 2041, Greater Vancouver area is going to have another 1 million people here. Okay, where are they going to fit everybody? The only way is to densify. So when we talk about fitting all those people, it's not just in Vancouver, but the Greater Vancouver. So you have to look at densification, and wherever there's SkyTrain stops or future light rail transit stops, that's where the growth, the majority of the growth is going to be. So you already see that with the Brentwood Center. You're seeing that with Oak Ridge, Cambie. Everything is just expanding based around SkyTrain stations. Okay, that's where the densification is going to be happening. For those that don't want to be living in condos or townhouses, they're starting to move eastward because they want the space and the land. Pushing out to Maple Ridge, Abbotsford, Chilliwack, that's all expanding. With the Port Mann being twinned, you're actually getting more accessibility to those areas. Earlier this week, on Tuesday, I drove out to Chilliwack. It just took me about 55 minutes to go from Burnaby all the way out to Chilliwack. That was probably about 80 plus kilometers in 1 hour. So that's pretty good. When you can actually buy for a $400,000 property on Chilliwack versus buying 1.4 here, it's a bit of a kind of a balancing game in terms of what's more important. The way the current market conditions are within Vancouver, it's basically made a lot of people instant millionaires, especially if they bought it a long time ago. They basically, if they've got a home that's say $1.4 million, they sell it, they got the cash, move out to Abbotsford, Chilliwack, and Maple Ridge, you can still get $400,000 or $500,000. Then you got about $900,000 to play with in terms of the savings that you can start investing. So if somebody has that, they then are more financially independent, then they can have choices. They don't necessarily need to be working all the time, or if they got a pension, then they can kind of scale back, spend more quality time with the family, volunteer or travel, whatever it may be. It's more a better quality of lifestyle. But once they sell out of Vancouver and they move somewhere else, it's pretty difficult for them to buy back into Vancouver because the appreciation out in the valley is not going to be the same as Vancouver. So that's a choice that they're going to have to make. But in each of those communities, there's a lot of amenities being made available now. So they don't necessarily need to come to Vancouver for kind of day-to-day type of activities. So if we look at, do you need a lot of down payment? No, you don't. There's properties available even within Greater Vancouver area that's $200,000 as a condo. Buy that as a purchase, 20% down, and that'd be $40,000, and we treat this as a 5-year term. So in basically on cash flow basis, if you get $100 per month, and over 1 year you get $1,200, 5 years you get $6K. Okay, mortgage pay down over the first 5 years is basically about 10%, 10-12%. So you have a tenant that's acting really as an employee for you. They're going out and working every month. They're coming back and they're giving you rents, which includes principal plus interest component to it, right? So that principal component is paying down your mortgage on a monthly basis. And over 5 years, we'll treat that your mortgage was $160,000 to start. So in 5 years, your balance would be $16,000 less, okay? As well, even on appreciation of 2% a year, that will give you 10% roughly in 5 years. That's 20K. So when we add 6K plus 16 plus 20, that's 42. Your initial investment is 40,000. Your return is 100% in basically 5 years' time, right? Approximately compounded, it'd be about 16, 17% a year. But you can't get that in the stock market with all the volatility. You invest that money in the stock market, even if you have 1,000 shares of a company, somebody who has 1 million shares floods the market, pre-market, before you can even decide. You have no control whatsoever. At least with cash flow properties, even in a market where it starts going down, you can kind of ride through the wave and the cycle because you've got cash flow during that time. Right? You decide when to basically dispose of the property. So even in a situation where, let's just say there's no cash flow and there's no appreciation, so 5 years later, it's still at 200,000, you're going to get 16,000 just from the mortgage pay down. That's 40%. So 8%, 6 to 8% per year compounded, guaranteed. As long as you do your job in terms of making sure there's no vacancy, then you're going to be earning that. Any questions with that? Yes?
How did $100 a month cash flow become $6,000?
Sorry?
How does $100 a month cash flow become $6,000?
So $100 a month, 1,200 in 1 year, 5 years, 6K. Yes, we treat this as a 5-year term, mainly because 5 years, if you try and, that's when the mortgage pay down starts really, it doesn't pick up at 5 years, but once you start going to 10 years, that's when it starts picking up. But if you try and get something that's like a 1 year, 2 year, you won't see the really big uplift in appreciation yet. So if you try to get like refinance in a couple of years, you might not be able to pull much out. So treat it as a 5-year term investment wise. Yeah, because you don't know what's going to happen in 2 years. It might start going down, right?
So you said total gain is $42,000.
Yes.
Initial down payment is $40,000.
Yep.
This is a $2,000 difference. How can the return be 105%?
The 2,000 divided by the 40 is the 5%. Like,
2,000 divided by 40.
like you're right here.
Yeah.
So 6 plus 16 plus 20 is 42.
Yeah.
So you're saying where's the difference? This is your initial investment.
Yes.
Yes. So your gain is actually like you're doubling in that situation. Like your 42K is your return.
40,000 is your return. Okay.
Yes. So in 5 years' time, you have that much equity available. So at that time, I'll go into the next slide afterwards in terms of how you can actually really like supercharge your portfolio. Okay. So I'm going to get into the through this is the supercharge. Okay, this is what you got to pay attention to. So if you start with just buying that first property, okay, and all you do is just add $100 into your savings account every month, okay? When you start off, by year 5, you'll have enough equity to actually buy the next property. Okay, that $100 per month kind of adds factors in the increase in potential price at that time, because you're not buying 200 through the same price throughout. So there's going to be appreciation along the way. But if you take that, every 5 years you have enough equity to basically refinance and then buy another amount, you're doubling along the way. So if you do this for 25 years, your initial investment of $40K would turn into 1.6 in 25 years, all by itself. Okay? So by 25 years at that time, you're onto your 32nd property. Okay? Just through that doubling effect from your initial investment. Yes, Zingy?
So you have 32 properties by the end? Or
Yes.
You
Yeah.
have 32 properties?
You're buying your 32nd.
No, like you have 32 properties all together? Or
Yeah,
you
yeah.
moved on?
You're onto your 32nd. So if you start off, say, when you're 20, by the time you're 45, you're onto your 32nd. You give it another 5 years to get to 50, you would be onto your 64th. Just from that initial, because it becomes exponential afterwards, right? So you're always in this situation refinancing the 80%. So we don't know what the rules are going to look like 25 years down the road. So this is what we can just project right now. However, over time, what you can still get to 1.6 by starting to pay down your mortgages too. This is equity. That's all it is. So imagine if you had everything paid off, and instead of needing 32 properties, but you only need maybe even, just 10, but it's worth 200,000. 10 free and clear properties, that's $2 million right there. So we don't need, or even 8, you'll still hit 1.6. You don't need to make it complicated. In a sense, the larger your portfolio, the more management you have to do. Like Vicky, you're in the business. So in this way, it's less is more at that point where it's free and clear, right? So this, imagine if you were getting, for this condo, $1,000. Okay, $1,000 and you got free, 8 properties free and clear. That's 8,000 positive cash flow for you, passive income. So most of us right now, who's focused on, the only way that they're getting income is active income. So active income is when you're trading your time for the dime. So you only get paid when you actually go to work. Who's in that situation? Yeah. So passive income is where basically it's working for you when you're not working, or when you're sleeping, when you're on vacation, you're in a washroom, whatever it may be, it's working for you. So some of you guys are, like Gary mentioned, Kindle publishing ebooks and stuff like that. So that's where leverage, like once you create a product, there's leverage after that. So every additional sale that you get, you could be sleeping, you could be driving, whatever, that's passive at that point. So the idea is to not always just focus on active income, because you can only scale so much, okay? Get your active income working for you such that you use your active income to buy assets for you that will generate you passive income, okay? So through that passive income, you want to build enough assets such that it can cover off your daily expenses. So once you've got your daily expenses covered, then whatever's left over, inject that back into your active business to generate even more income to buy more assets. So it's the whole rich dad, poor dad cycle, right? So that's the whole idea, so that it can be making your money work harder for you. That's the whole goal, so you can have that balance, right? Who works a lot better when they don't have to think about their finances? It's a lot of stress, right? Right, because you're always like, you get done with whatever you're working on, project, and then you're thinking, okay, I spent so much time working in the business, I didn't work on the business to be able to make sure that the pipeline is full. Right? Then you got to worry about next month and the month after that. Who gets worried about that? Right. So having something like this kind of smooths things out so that you've got a base that's growing over time. Does this make sense?
Start with 5, start with 5 years.
Yep. So if you have greater appreciation, it's going to go even faster. If you have, you have less, then it slows down. But this is kind of the idea.
Thanks guys for watching my video. Please subscribe and share with your friends. Email me if you have any more questions. Thank you.